Good afternoon. Thanks to everyone for joining us. For those of you who used to be resident here in Rochester, it's a very Rochester day today. We're going to top out, I think, in the low single digits. So very pretty, but very cold out. I'm going to talk to you today about why Americans are so unhappy with the economy. But let me tell you a little bit about myself first. I'll be brief about this. That from 1987 to 2009, I was a finance and economics professor at a number of schools. I was an academic. I worked at Northwestern, Stanford, Minnesota, Iowa, a bunch of places. And since 2016, I've been delighted to be here at Rochester. I was an economics professor for quite some time, and now I'm a finance professor. And I'm very delighted to be able to hold the title of the Louise and Henry Epstein Professor of Business Administration. Very grateful for their support to the school. And so that's one part of my background. I'm an academic. The other part of my background, though, which is going to be important for this talk, is that I'm also was a policymaker. And specifically, I was a monetary policymaker. So from 2009 to 2015, I served as president of the Federal Reserve Bank of Minneapolis in Minnesota. There's a host of duties associated with that. But one of the things that I did was that I served on the Federal Open Market Committee, and that's the monetary policy making arm of the Federal Reserve. And so it's really with both of those lenses that I'm going to be talking to today. And it's really, as I think about what I'm going to be saying to you, both parts of my past and my present matter, but I think this former policymaking side is certainly going to play a big role. So with that as a backdrop about who I am, let me dive into what I want to talk about. I'm going to pose the problem as being a conflict in the data. The conflict is going to be that we've had good macro data, but we have unhappy Americans, specifically unhappy about the economy. I'm going to turn to what I see as a potential resolution of the data conflict, and it's going to be the behavior of what economists like to call real wages. And I'll explain what those are when we get there. And I'll talk about the possible policy implications of my proposed resolution in the last part of my talk, and then we'll throw it open for questions. And I'm excited to engage in that portion of the webinar. So those are the 3 parts of the talk. Let me talk first about the conflict in the data. All right, so the first part is, let's look at the macro data. And here I'm calling a little bit on my, there's lots of data available. What should we look at? And here I'm calling a little bit on my Federal Reserve background. These are the data we would typically talk about when we talk about what's going on in the economy. What's the state of the economy? What's our dashboard? And these are the numbers we would typically look at. And so the first number is how much has real GDP grown over the previous year, and that's basically how much has the total production in the United States grown over the preceding year, and the answer is 2.7%. That's not an astounding number. On the other hand, it beats the average over the preceding 25 years, and it's better than where the Federal Reserve they offer long-run projections where they think GDP growth is going to be going over the longer run, and they see that as being at 1.8%. So this 2.7%, not outstanding, but certainly better than average, and better than where at least the Federal Reserve thinks we're going to be going over the longer run. Unemployment. So the unemployment rate in the third quarter of 2024 was 4.2%. It's come down a little bit since then, actually. That's much better than the average over the past 25 years. Now, this is a different talk, but this is a sign of policy that wasn't so successful in terms of how high unemployment was in the wake of the Great Recession. And the long-run projections for unemployment by the Federal Reserve are, again, around 4.2%. And I just looked at the last 25 years. Really, this 4.2% number is some of the best that we've seen in going back to the early 70s and late 60s. So this is a very low number for the United States, but from both a historical perspective and then what the Fed sees as normal going forward. Now, what about inflation? Obviously, a lot of talk about inflation, a lot of concern about inflation, and the CPI inflation rate is 2.7%. There's lots of different measures of inflation. Here, I'm trying to use the one that probably gets the most attention in the media. This is the Consumer Price Index. It's attempting to figure out how much has a price of a typical bundle of goods and services for a person living in a city. How much has that grown over the last year? And that number is, as of the third quarter of 2024, was 2.7%. That's about average over the past 25 years. That is aiming to get this a little lower, 2.4%. And some of you might know, oh, the Fed is actually aiming for 2%. This gets into the minutia of inflation. They target PCE inflation, which is a little bit different from CPI, so we end up with a little bit of a gap here. But basically, the punchline from all this is these are good to normal kinds of numbers that we were facing in the third quarter of 2024. I'm just this offers a repeat of what I just said. Okay, and so that's the situation in terms of the state of the economy. So that's on the data side. But if we get to actually talking to people about how they feel about the economy, only a third of those surveyed saw the state of the economy as good. This is a survey taken after the election. But this metric was about the same throughout the year. Obviously, if you followed the political news at all, you've heard that the unease about the economy was something that ran through the coverage of the feelings of the electorate as we headed into the election. This is a point. The point here is simply that those feelings have carried over after the election. And this is a survey that was conducted by the Associated Press and the National Opinion Research Center at the University of Chicago. So, these are folks that are attempting to be as neutral as possible in their collection of data. Right. So that's the situation, and we had solid macro data, good to normal, I would say, and then but only a third of those surveyed saw the state of the economy as good. So what is going on here? What's the challenge here? So let me talk about a potential resolution of this conflict. I think the key is going to be that wages have grown slower than prices. Now, I'm being a little sloppy with my language here. I'm going to be sloppy throughout, so I'll highlight it right now. When I say wages, I'm not just talking about what people's take-home pay. I'm including in it any increases in benefits they might have had as well. So I'm going to take into account both the wages side and the benefits side. And when you do that addition, wages have grown at about 4% per year under President Biden. So that's starting for the fourth quarter of 2020, the last quarter of President Trump's first term, and then after that, wages have grown, as I say, about 4% per year. Now, this sounds fast relative to normal growth rates, and it's pretty much what we think of as representing growth in a healthy economy. When you look at that level wage growth, the difficulty is that this is a little misleading because this is telling us how much the dollars people are getting is growing, but you can't eat dollars. You can only eat what those dollars can buy. Okay, that's one of the key messages of economics, and the key is that the growth that people have seen in their wages has not kept up with the growth in the prices of the goods and services they're trying to buy. So to see this, we can graph the percentage increase in wages since the fourth quarter of 2020, the end of, as I said, President Trump's first term, and then minus the percentage increase in prices over that same period. And this is what what economists would call the percentage increase in real wages. Okay? Now, this is a cumulative. So this is not an attempt to, I don't average in any way. This is a cumulative percentage increase in wages over this time frame and the cumulative percentage increase in prices. Now, so this is what we call the growth rate in real wages. And you'll see that basically that's fallen. It's come back up, and you'll hear it's certainly been a lot of when people talk about real wages. It's important, and I think it's right to quickly add that this is the first quarter 23 to the end of 24. Basically, we have seen an increase in real wages, and so the real decline is from the beginning of the end of 2020 through the beginning of 23. But we get to the end, third quarter 24, when the election is last data we have available, really, I guess, is right now. We see that real wages are down by about 4%, which means that on a cumulative basis, while we've seen this strong growth in wages, prices have grown by even more, by 4%, by 3.6% more, as we'll see in the next slide. What this decline means in actual non-economist speak term is, if you are trying to buy the same amount of goods and services that you were buying in 2020, you have to work more hours in order to do that. That is what this graph tells you. Now, is this usual? Is this a standard thing to see? And that actually, no. In some sense, the behavior of real wages under President Biden is unprecedented. Now, here what I've done is I haven't looked at all presidential terms. What I've looked at is the growth of real wages over the prior 4 years for presidents who were seeking re-election since World War II. So you might notice I don't have, for those of us who remember the 60s, I don't have Johnson 1968 here because he wasn't running for re-election in that year. Took himself out of the running for other reasons, but again, another topic. So this is basically, suppose I gave this talk in 1956 and 1984, and what would I be telling you about the growth in real compensation per hour under each of these presidents? Now, actually, it's a little surprising. The first Clinton term, I was a little surprised by this, is where you see a negative number. First Obama term, this was certainly not surprising to me because it was very tough labor market period. This is when I was at the Fed. But basically, this number of negative 3.8%, I think I said 3.6 earlier, negative 3.8% is striking because it's first of all, we don't have that many negative numbers, and then it's the lowest that we've seen since World War II. So that is my explanation for why people are so unhappy with the economy. And I'll say one thing about inflation, and when you'll often hear when people are asked about their concerns about the economy, and a lot of the exit polls for the election focused on this, they're unhappy with inflation. But I'm translating those words into, we see that if you go back here, inflation isn't that crazy high. What I'm translating that into is, hey, when I go out and try to buy food and toys for my kids, when I go out and do that, the prices for those things seem very high to me compared to what I'm earning. And that, or if I pay for rent, which is actually another key variable, right? If I pay for rent, that seems very high compared to what I'm used to in terms of what I'm able to earn when I work in my job. And that is how I translate when people say they're concerned about inflation. I'm translating it relative to what they make, and so that's basically the translation that's going on here. So, what do we take away from this? So why have real wages fallen? And from an accounting perspective, it's not really an economics perspective, more an accounting perspective. There's only real two things that can be going on. So one possibility here is that workers have become less productive over time. And so firms really can't afford to keep paying them higher real wages. if the productivity of workers is falling during President Biden's term, for whatever reason, and we're going to see this as a hypothetical, so I'm not going to talk it through. Then firms are not going to be able to keep increasing real wages, or they would go out of business. So that is one possibility. The other possibility is that the firms have become more profitable over time. So we have productivity going up, wages, real wages falling. Well, that's a good situation, right? You've got a worker who's becoming more and more productive over time. You're paying them less relative to what you're charging to your customers. You're be making more money. So which is it? Is it productivity, or is it profitability? So let's look at labor productivity during the Biden administration. And this is basically output per hour for all workers on labor productivity. And in fact, we see that, there's ups and downs during the Biden administration. And, but there was a sharp increase in labor productivity in the last couple of years in particular. And essentially, the bottom line is that workers are more productive, have become more productive, not less productive during the last 4 years. Now, we can put some numbers on this. Workers are being paid less, really about 3.8% less per hour, and they're being paid and they're producing 3.5% more. Okay, so this is you add these together, and what that means is that businesses are facing lower costs and getting more out of each worker's hour. They're making 7% more profits in 2024 per hour of work than they did in 2020. So profits, that sounds good, right? Having profits rise sounds like a positive. But having positive profits should spur entry. It should spur competition. If all the businesses, the typical business is making more per hour out of each worker, we should see startups come along and say, "Hey, I want to be able to hire those workers with these productive technologies." That kind of entry, that kind of competition would ameliorate this mismatch between wages and prices, because it would drive down prices and drive up wages. I think a question we have to ask ourselves is, what's going on in terms of what's preventing this entry? And you can hear stories from both the left side, the Democratic side of the aisle, Republican side of the aisle, who will be pointing to what these barriers might be. But whatever they are, they're keeping real wages low, and importantly, they're slowing down overall economic growth. It's not just a matter of real wages. It's also, if we don't have this kind of entry and into business, we're robbing ourselves of output and production. So I would say lowering these barriers to entry and competition seems like a key economic job for the new administration. I think whether or not those are their priorities, they're probably not listening to me right now. But that would be my recommendation, is for something to focus on. I think there's another takeaway as I wrap up here. I showed you 3 variables at the very beginning that the Federal Reserve and other macroeconomic policymakers tend to focus on, which is real GDP growth, inflation, and unemployment, and especially inflation and unemployment. And in fact, these are the goals that are enshrined in statute. To go back to the Humphrey-Hawkins Act, this is what Congress and the Federal Reserve are supposed to focus on. The problem is the rate of change of prices. Inflation itself isn't seen to be capturing what's relevant to households about what they're worried about when they go to the grocery store and pay their landlords. So what I take away is that policymakers also need to be concerned about the behavior of real compensation and not just in inflation and unemployment. All right, that's it. I look forward to your questions.
Thank you, Narayana. Jamie here from Simon Advancement. I'm going to read off a couple questions that we have, but please, we don't have too many so far, so attendees, please drop them into the chat when you have them. The first is, what is your opinion on President Biden's oligarchy warning?
Yeah, I think he's probably speaking more broadly than I'm able to in terms of, he has, I think, some political and governance concerns that I'm not going to be able to speak to as a mere economist. Um, but I can speak to it in terms of oligopsony. So oligopsony it refers to a situation where you have a small number of buyers, or you have oligopoly, a small number of sellers. And that's a reference to a situation where you have a limited amount of competition in either a labor market, in the case of oligopsony, or in a product market in the case of oligopoly. Now, oligop here refers to a small number of firms. Really, sometimes of course, we're more familiar with the term monopoly or monopsony. That will be a case where you have a single firm. And there's a general recognition among economists that a single firm is not enough for true competition to exist. The oligopsony or oligopoly considerations are we have a small number of firms, and that too is leading to limited competition. So I think my punchline at the end is, hey, the fact that real wages are growing so slowly is a warning of about the limits of competition and the limitations of competition that we're seeing in our economy. And it sounds like, when I give this talk and I talk about these considerations, it sounds like, I'm just this pro-labor person. I'm worried about workers. And, my previous policymaker had, and as an economist, of course I worry about their situation. But honestly, this is about making the pie bigger. If we have limited competition, what happens is limits on competition leads to limits on output production. It's always true. It's one of the basic principles of economics. And so the oligopsony and oligopoly that we see in the economy, and we see translating itself into low real wage growth, that's something that we should be working on. Now, how best to address that? It really depends on what you think the causes of those limits of competition are. Some would point to undue government regulation, and some would point to other causes in terms of business themselves preventing entry. So where you think the causes are really matter, I think, in terms of how you combat these limits to competition.
Along those lines, could you address how the tariffs might impact real wages?
Yeah. So, obviously a lot of attention to tariffs. I haven't worked through exactly how tariffs will affect real wages in the aggregate. I think the question is so to go from zero tariffs to a low level of tariffs, I think the questions become very complicated. I think as we talk about some of the numbers that have been thrown around by the incoming president, 25% kind of number. I think we can start to say that real wages would fall. That would be a negative for real wages because of the increase in price growth, prices would overtake the increase in wages. So I'm not standing here and saying, I think this is often true with policy questions. Questions are nuanced, and so going to say, oh, zero tariffs are always optimal. I'm not that person. On the other hand, I think it's hard to get from some of the nuanced and delicate calculations that I've seen offered by the experts in the incoming administration to numbers like 25%. So if we actually saw these big tariffs, I do think that would probably move against real wages as opposed to supporting them.
This alum has read reports that suggest that the average age for a person being able to afford their first home is 38 years old, an all-time high. Any thoughts on how that might play into perceptions?
Yeah, so housing, I haven't seen that exact number, but I'm not surprised by it. Housing, I think in terms of the purchase price, the way we think about that in terms of the consumer price index is we try to impute from the value of a house what its rent would be. So it doesn't show up all that directly into the consumer price index. With that said, it's going to be absolutely another marker of, that's a translation. I think what I like about that is it's a translation of a price variable. Just saying, oh, a house costs $400,000 doesn't tell you, how many hours does a person have to spend working to get that house, and that you're the offering up how long, how old people are is telling you what kind of how long they would have to work to get something they want, and that's a value. Um, I think that many people, both on the left and the right, actually have said that one of the challenges in housing is where people want to live. There's a lot of restrictions on building, and that's a housing specific response, but it's certainly one that I would be supportive of. That you look at places like I used to live in Northern California, a lot of restrictions on housing, exactly where people want to live and business want employees. So that's something to be try to be addressed as much as we can.
Why has the growth in real compensation per hour, why was that so high in 2020? And how much of it was related to coming out of the pandemic rather than policy under a certain administration?
Yeah, so I think that we saw very strong real wage growth. And I showed you that in my chart, that under President during President Trump's term. Um, you know, and I want to back away from something if I came across as saying, "Oh, this was President Biden's fault." I'm very skeptical of the ability of presidents in themselves to be able to influence the economy. Um, but I follow a lot of sports. Sometimes the coach gets fired, even though the coach has done nothing wrong. It's just the one loss record is what it is. And that's what the sense in which I'm offering this up is that I think that the situation is that Americans weren't happy with the economy, and I think that translated in the way they voted. It's not the fact that President Biden's not out there setting wages and setting prices for the whole economy or anything like that. Um, so is this this uh, fall in real wages somehow a correction to what we saw during COVID? I think some of that's going on, but that's what people have in their heads is, hey, I think the times were better at a certain point in time, and I think that's what we have to keep track of in terms of when we try to think about how happy they are with the economy.
Okay, we have maybe 1 more minute for this last question. Do you think CEO wages are influencing real wages?
So CEO wages are very high by historical standards relative to the wages of the typical worker. Um, you know, they are not, averages always are a little bit influenced by the very high end, but most of this is not going to be influenced very much by the wages of CEOs. This is going to be capturing more quote unquote the wages of the typical person. If I showed you medians, I would would be less sensitive to that. We would get similar answers.
Okay. Well, we're at time. Thank you, Nariana, for an insightful session, and thank you to everyone who tuned in today. Please continue to follow the Dean's Corner blog and Simon Advancement for upcoming events and webinars like this one. Have a wonderful rest of your day, and thanks again for joining.
Thank you.